Okay, awesome. We are now live on YouTube as well. I believe I'm still audible to everyone here.
Yeah, it's loud and clear, man.
Awesome. So let's begin today's webinar. The topic is very interesting now. So right now I actually prepared that especially since tomorrow is the expiry day, it could have been benefited. Then I realized that actually now every day is the expiry day except Mondays. The lot of changes in the rules and everything. We are very glad that the topic is actually options trading for expiry days particularly. We have with us today Kirubakaran Rajendran. He's the founder and CEO of Square of Bots, algo trading firm with he has more than 14 years of experience in Indian stock market. He's a statistics graduate who worked in IT firms for 10 years and quit the job to become full-time trader. His story is also quite interesting and we have already covered in our Made for Trade series as well. Till now, he has actually trained more than 10,000 traders on rule-based trading through educational webinars and video contents. So this is Kirubakaran's, I believe, fifth or sixth webinar with us on a different topic altogether, and we are glad that he is again today here. Kirubakaran, over to you.
Thanks, Rahul. Thanks for having me in the session. So, definitely, people who are really comfortable with Hindi, and if they are not comfortable with English, no worries. I'll try to keep it very simple. So definitely, anyone who is listening to this webinar will be able to understand the complete content which I'm trying to say. So the overall session, it's going to be on an option basis. So it's instead of straight away, directly, I'm going to explain about the option trading strategy. I'll just try to explain what is the thought process behind it. And then I'll try to explain what is the strategy and how people could trade this specific strategy on expiry days. And then also I'll explain how the strategy has performed in the past. And then I'll also explain for all done users, they could easily trade this strategy automatically through our platform, which is totally for free of cost. So people who are attending this webinar will totally provide them totally free of cost. And then even people who wanted to try it out, they can try it out for a complete 1 month at free of cost. So I'll explain everything in this webinar. So I'll just try to share my screen. Please confirm if you're able to see my screen now.
Yeah, we can.
All right. Fine. So, the topic is going to be, the right way to build a trading strategy with respect to options. I'll explain what is the actual step-by-step process in creating a specific option trading strategy. So before I go ahead and explain, I'll just give a short brief intro about myself. So I've worked in companies like Infosys, Bank of America, Xerox in the past. So basically, I'm an IT guy, worked almost for 10 years. And then later I quit the job and started focusing my trading full time, and also started focusing my startup Square of full time. So I started trading in the year 2008. So that was the time I started trading, where back then, options trading was not much popular. So I started trading initially with the intraday with stocks, later traded with futures, and then moved on to options eventually. And almost from 2008 to 2014, almost for 6 years, I was trading. I was a discretionary trader. So I did not have any rules as such. So whatever the news that I see, whatever the stocks that is being discussed in the channel or in the social media, I try to trade on that, get in and get out. I did not have any proper system as such. So only from 2014, I started focusing more on rule-based approach, because I was not having enough time to focus on my day job as well as trading. So it was really difficult to manage both my job as well as trading. So eventually I moved into rule-based trading. So once I moved to rule-based trading, all I have to do is just focus on what are the list of things that I need to do. For an example, if I have to get into a stock, I'll clearly know when to enter, when to exit, how much quantity do I need to buy, what is the overall position sizing that I need to do. So everything was proper in place. So I don't really panic when the position goes against me. So rule-based trading, more than giving profits, it really helped me in focusing, the overall process. So as I always say, once you have a clear-cut process, eventually the profit comes. So that is what I mainly focus on. So after 2017, I started totally into automation stuffs. Like I build my own trading bots. So Square of Bots is my platform, where if you go to squareofbots.com, you'll see it's kind of inbuilt strategies. People who do not have any built-in strategies, they come to our platform, using which they trade it automatically. So that is what my platform is all about. So coming to the topic, so I just wanted to ask most of the users here. Everybody knows about Warren Buffett, and everybody knows about Charlie Munger. Most of them knows about it. even people who get started with trading, they read about their codes, read about their books, and most of the people know about these two fellows, and most of them do not know about a person called Rick. So actually, it was Rick, Warren Buffett, and then Charlie Munger. Three of them started Berkshire Hathaway. But this guy is totally out of the picture now. Nobody knows about him, and nobody even know that there was a third person called Rick. It is the actual story behind it is during 1970s. During 1970s, yeah, during that time, all three people were a partner of Berkshire Hathaway. And this Rick, what he did was he was having over leveraged positions. He has this holdings of Berkshire Hathaway, so he used to pledge his holdings and he used to trade, he used to take positions, leveraged positions against multiple indices, multiple stocks. But during this 1970s, there was a huge crash where market almost tanked 80%. So when the market tanked 80%, he started getting margin calls because he was using leveraged positions. He used to pledge his holdings and then he used to take almost higher leverage, over leveraged positions, because of which he couldn't cover the positions. So at one point of when he was getting margin call, eventually he has to sell all his holdings. So Warren Buffett bought back all his holdings from Rick. And then now eventually Rick totally blown up his account and he was no more partner of Berkshire Hathaway. So when people asked about why was Rick is not part of Berkshire Hathaway, what happened to this Rick fellow, why he couldn't do what exactly you guys did, Warren Buffett answered that me and Charlie Munger, we always know that we are going to be rich one day. But Rick, he also know that he is going to be rich, but he was in a hurry, but we were not in a hurry. So with respect to investing or in trading, whenever you are really in a hurry to make quick returns, when you wanted to make overnight returns or when you wanted to make huge returns in short span of time, you tend to risk more. You tend to take many over leveraged positions, which is eventually going to blow up. So if you wanted to be in this game, if you wanted to be in the trading or investing, to get rich, don't be a Rick. Always have a clear-cut thought process in your mind. Always have a realistic expectations. It is going to be a long journey. So definitely, if you wanted to be rich in a short span of time, eventually you'll blow up your account. So that is a kind of lesson that I wanted to keep, or now I wanted to get started to keep keep that in your head before we get started with trading. Because with respect to current social media, like when you go to Twitter, you see a lot of people posting huge profits. So those huge profits are possible, yes, but when you tend to make such kind of huge profits, you tend to risk more, but eventually consistency matters. So don't try to risk and don't try to expect much higher returns. Making a decent returns is more than enough. I always say people who have lower capital, they expect higher returns, and people who have a higher capital, they expect lower drawdowns. That is the main difference. So when we are having a very lower capital, we always wanted to make higher returns. Because of that, we tend to risk more. So don't go in that zone. So that is the first and foremost lesson that you need to keep in mind when before we get started with this trading sessions. So the next part is, I always say data is a new oil. So that in the almost, if you see 50 or 60 years before, people started focusing more on fundamentals. Like during Warren Buffett or Charlie Munger period, they focus more on the fundamentals. They focus more on the business perspective, what that specific company is into. Based on that, they take decisions. And then eventually the people moved on to charts. Like they see charts, they focus on technical analysis, and based on technical analysis, they started taking decisions. And now it is more of a data oriented approach. So that is why you see like companies like WhatsApp, Facebook. Why should Facebook buy WhatsApp for almost $19 billion? Mainly because of the data WhatsApp holds. So Facebook really know that, okay, they have a huge user base, and because of those data that they have, definitely they can customize the ads. They can target the ads specifically to those users who are really in need, which is going to help the overall consumers, and which is going to overall help multiple companies out there. Due to which they paid $19 billion to WhatsApp. Even though WhatsApp was not making a single rupee of revenue, they were able to spend $19 billion to acquire WhatsApp just because of the data they hold. So I always believe data is the future. So when even with respect to trading, so as I said earlier, even though Warren Buffett is the richest investor in the world, there is another person who's the richest trader in the world. So Warren Buffett, we can't consider him as a trader. He's actually an investor. But Jim Simons is actually the best trader in the entire world. Because when you consider on a returns basis, Jim Simons versus Warren Buffett versus Jim Simons, Warren Buffett average returns is around 22%, whereas Jim Simons average returns is 66%. So he was able to make 3 times of what Warren Buffett makes just through trading, just through short-term trading. So Warren Buffett, on the other hand, he makes all this investment decisions based on fundamental aspects, what the company is doing and all those stuff. But Jim Simons doesn't care anything about the company. He doesn't even know what that particular stock is, what kind of business it is into. Whatever the data analysis suggests, if it suggests him to go long, he'll go long. If it suggests him to go short, he'll go short. He's totally data driven, and whatever the Renaissance Technologies, the hedge fund which he runs, that is the world's best hedge fund in the world, which has given consistent returns from 1988 to till date. And Renaissance Technologies is totally a quant-based approach, so it is not a similar retail traders approach. It is totally a quant-based, and all the people who are working in Renaissance Technologies are not actually traders. They don't even hire traders. They hire data scientists, they hire data analysts who could dig deep all this data and try to create some systems out of it, try to create some strategies out of it. So they give too much importance to data, and based on that only they were able to beat the index. They were able to make such kind of huge returns year after year, that too from 1988 to till date. So nobody was able to beat that kind of returns. So I'm quoting this example to give you a perspective like, okay, money can be made with respect to investing, with respect to trading as well. But with respect to trading, I'm trying to showcase how data-driven approach can greatly help. Because even the strategy which I'm going to explain is also not totally based on data, where you don't need to really focus on indicators, anything as such. So even though Warren Buffett versus Jim Simons was able to make 3 times of higher returns than Warren Buffett, still Warren Buffett is considered to be the richest investor. He is not able to beat Warren Buffett because Warren Buffett started investing at the age of 13 itself. But Jim Simons, he started very, very late. He started only at the age of 55. So after he crossed 55, he started trading. So because of which, the compounding effect works in the favor of Warren Buffett. That is the main reason. Otherwise, Jim Simons would have been the almost the richest person in the world compared to Warren Buffett. So, coming to the point. So, I've explained why data is important and why we should consider specifically based on data. So, let me start with a small story which people could resonate with, people could easily relate to. So, this is actually a true story that happened during 1920s or 1930s, I think. So, this is actually about incident that happened in US. It's on an automobile industry incident where it is kind of General Motors. Anybody knows about General Motors? So General Motors is actually a company which manufactures cars. So during 1920s and 30s, they manufactured a new car. It is actually one of the best selling model back then. So it was selling like an hot cake, and everybody wanted that car. And people who purchased that car, they started facing problems. So one such customer, he faced a problem. He said that, see, I am having a problem. My car is allergic to ice cream. So what happened is, so he sent out a letter to this General Motors company stating the letter headline was, my car is allergic to ice cream. So many people ignored it. They thought, okay, how could a car be allergic to ice cream? Nobody believed in it. So for a long period of time, that letter was there and nobody read it. He mentioned in the letter stating that whenever I go to an ice cream store and buy a vanilla ice cream, my car doesn't start. So this is the issue. So that letter was not read by anyone. So it was there on a desk for a very longer period of time. Then at one point of time, the CEO happened to read that letter. So once he reads that letter, he directly assigns top engineers, and he wanted to go and visit that specific guy and ask them, sit with them and find out what is the problem and fix it. So now he sends an engineer to his place. So the engineer went to his place and he asked all the details. The car owner said that, see, my car is really allergic to vanilla ice cream because whenever I buy a ice cream and get into a car, my car doesn't start. So he said, okay, fine, I can understand your concern. No, let me be with you. I'll try to come and visit your place at least for next 1 week or 2 weeks and try to see what is really happening. He said, no, what happened is every single day we have dinner at our place. So once the dinner is over, we drive our car to the nearby store, ice cream parlor. We buy ice cream and come back to the car and we start the car and it doesn't start. So this is the issue, he said. So he said, okay, tomorrow I'll join you with a dinner. So let's have dinner together and then let's have ice cream together. So the next day, the engineer and the car owner, both of them have dinner together. And then they went to a nearby ice cream parlor store and they buy a chocolate ice cream and they come back and they try to start the car and the car gets started. So it's fine. So he said, okay, there is no issues today. So next day, again, the same process follows. They go and have a dinner and they go to ice cream parlor. They buy a strawberry ice cream this time and they come back to the car and they try to start the car and it gets started. No issues. And the third day, similarly, after the dinner, they go to the ice cream parlor store and now they come back and try to start the car and the car doesn't start. So do you have any idea why the car doesn't start? So let me see, you can post it in the chat window or Q&A window. I just wanted to see what is your opinion on that. Why this car doesn't start when the same car started for chocolate ice cream or strawberry ice cream, but doesn't start for vanilla ice cream. So now the engineer, he himself is very curious because he can't say the same reason to the CEO, otherwise he'll get fired. So he can't say that, yeah, I've literally seen the car is not starting when we bought the vanilla ice cream. So what happens is now we wants to analyze all the data. He said, okay, let me analyze all the data, like at what time the car starts, I know what is the fuel tank capacity level and what is the total journey, how frequent he is traveling. So all these data he captures us and finally he is able to conclude why this car doesn't start. And finally the conclusion is he says that it is due to the time taken for the vanilla ice cream to get delivered. What happens is, chocolate ice cream, strawberry ice cream, all these ice creams are he goes and he just wait for the car to get prepared and then he buys it and come back. But whenever he restarts the car in less interval of time, since vanilla ice cream is like most favorite ice cream, most favorite flavor, it is kept at the start of the counter. The time taken to deliver vanilla ice cream is very less, but the time taken to chocolate ice cream or strawberry ice cream to deliver is much higher. So the moment he stops the car, he gets in and gets a vanilla ice cream and comes back, and immediately when he tries to start the car within short span of time, there is this vapor lock that gets happen with respect to that specific model. So back then, when you stop and restart the car within short span of time, this vapor lock issue used to be there, and later they fixed it out. So once they found out, okay, this is the issue which is causing no problem with respect to that specific model, all those engineers sat and then they try to fix, they recall the model and they try to fix it, and then the car started even more much better. Like the number of cars, the number of models that sell, that used to sell every month has gone up much exponentially higher after they fixed this issue. So this is kind of the thought process that we need to keep in mind. So we always have this problem of, okay, why I'm not able to make profits in trading is because we need to ask the right question to ourselves. We know that there are multiple trading strategies out there, but in spite of so many strategies, so many webinars, so many workshops, still people we are not able to make profits out of it or not able to stick to it is because we are not able to find the trading system which is suitable for us. So there are like many many traders who get started with option buying. So option buying, you could see, okay, 5 rupees option going to 50 rupees or 100 rupees. So they tend to trade with these option systems, option buying systems. But these kind of movements where 5 rupees option moving to 50 rupees or 100 rupees are rare event. So based on that, if I try to focus on, okay, I wanted to become an option buyer and try to focus on option trading strategies, I might not be able to stick to it because that strategy doesn't suit my personality. So we need to ask ourselves what kind of trading strategies suits us. So we need to keep that in mind, and accordingly, once you have a specific strategy that suits your personality, you would be able to stick to it. And once you are able to stick to it, then no matter what, eventually you will be able to make the consistent profits over the long run. So the first and foremost rule is not to lose big. And if you do not want to lose big, option selling is the right way to get started. And with respect to option selling, theoretically, it might be, saying that, okay, it has unlimited risk. But when you trade with the proper risk management, even option selling could give you a consistent returns. So that is one kind of strategy which we are going to focus today. So it's what I call it as a rolling straddle strategy. So most option sellers know what they do is they try to trade at the money call option or at the money put option in the morning. They'll try to trade with a fixed stop loss on either side, like short ATM straddle, short call option, short put option, have a fixed stop loss of 20 or 25%. So this strategy works well if market moves in one-sided direction. Like if market moves up, then your call stop loss will get hit. No, you will come out with a very minimal loss on call side, but your put side will decay, so you make money. Similarly, when the market goes in downward direction, your put stop loss will hit. Now you come out with a minimal loss, and your call option will decay, so you tend to make higher returns. So this strategy works as long as market moves in one-sided direction, and most of them are already trading this strategy. So what is the alternate? So this specific strategy might get into loss when market moves in zigzag mode. When market moves up and moves down, again moves up and moves down, it is going to hit both call option and put option stop loss, so it's end up in loss. Another issue most of the option sellers face is these option spikes, suddenly market moving up 100 points or 200 points, suddenly market moving down 100 points or 200 points. So when that kind of sudden movement happens, all your pending stop losses gets hit. So when your pending stop losses gets hit, no, again market will move in your favor. So you will tend to believe, or you tend to think, okay, if this stop loss is not hit, or in the system, the overall returns would have been positive. But because of this, it is actually hitting the stop loss and making losses. So that is why we created this rolling strategy where it is totally focused on why you should focus on specific to expiry days. So when I created the strategy, I did not have in mind that, okay, I have to create the strategy only on expiry days. It is a strategy which I created. Okay, I wanted to trade a strategy on all days where when the market moves in zigzag mode, it should end up in profits. So the rules of the strategy is simple, where you trade Bank Nifty weekly options and you short at the money call option and at the money put option, where you enter at 9:20 in the morning and you exit at 3:20 in the evening. The only difference is we are not going to use any stop loss on the premiums. So you don't use any stop loss on the option prices. Instead, you're using stop losses on the underlying, which is on the Bank Nifty. So when Bank Nifty moves 0.4% on the upside or 0.4% on the downside, then only we are going to exit this position. So you initiate the trade at the money short straddle call option and put option at 9:20, exit at 3:20. That's all if the stop loss is not it. If the market moves, if the Bank Nifty from 9:20, if it moves 0.4% on the upside or 0.4% on the downside, then you square off all the positions and create a new straddle. That is what rolling straddle is. So you can't keep rolling the straddle forever. So I have mentioned re-execute 5 times, which means you can roll it up to 5 times. So that is what it is. So let me explain with an example. So you consider this. So Bank Nifty, which is trading around 40,000. So the 40,000 is the spot where Bank Nifty at 9:20 trades at 40,000. So you short 40,000 call option and 40,000 put option. Now you wait Bank Nifty, you wait for the Bank Nifty to move up or move down on the 0.4%, which is our underlying stop loss. So 0.4% is 160 points. So from 40,000, if Bank Nifty moves to 40,160, or if it moves down to 39,840, so this is our stop loss level. When it goes beyond this level or when it goes beyond this level, you're going to exit both call option and put option. That's all. That is the rule. So once you exit it, so consider this in this example, Bank Nifty moves up. So it moves up and it crossed 4160. So once it moved up, you consider the below example, the second table, where I have mentioned 40,160 is the spot. So which means that we would have closed the old positions, 40,000 call option and 40,000 put option we would have closed. Now we would have created a new ATM straddle. Now check at this point where when Bank Nifty is trading around 40,160, what is the at the money call option, at the money put option? So as per that, the at the money call option will be 40,200, at the money put option will be 40,200. Because when you round off the 40,160 level, 40,200 is the spot. I mean, the at the money strike. So now you shorted 40,200. Now your stop loss is same 0.4%, where from 40,160, if Bank Nifty moves again up, further up to 40,320, or if it moves down to where it was to the 40,000 levels, you will exit it. So this is the rules. So as long as Bank Nifty keeps moving on the upside or on the downside 0.4%, we are going to close square off both the positions and create a new position. So that is the rules of the strategy. So as per the rules of this strategy, this is the overall returns, where you tend to give almost 4.7 lakhs of overall profits with 35,000 rupees of overall drawdown. And the average profit is almost 331 rupees per trade. and expectancy is 0.28 and winning accuracy is almost 60%. So seeing this, most of the option sellers, what they do is they go to a backtesting platform, they try, any kind of variations like this, they backtest it. And once they see the overall results, okay, it has given almost 4.7 lakhs of overall profits with almost 35,000 of overall drawdown. So probably this is a now much better strategy. Let me start trading live. So second problem is, even though they're ready to trade live, they initially start with a higher capital. They'll trade with 10 lakhs, they'll trade with 5 lots or 10 lots. But the problem is, you need to understand, like, just like the other example which I told about the car incident, where once you dig deep and gather all the data, you will clearly understand the actual concept behind it. So when you run the strategy, you understand the rules, okay. But when you see these overall results, you need to dig deep and see whether it is actually a tradable strategy or not. So that is what I did. Okay, this 4.7 lakhs is the overall results, is fine. So let me see the breakdown. Breakdown in the sense, okay, we are creating a first straddle in the morning. If Bank Nifty moves 0.4%, we have to create second straddle. From there, again, if Bank Nifty moves 0.4%, we have to create third straddle. So likewise, I said 5 different re-entries. Apart from the first entry, 5 different re-entries, right? So totally 6 straddles are there. So I segregated what is the overall profits coming from each of these entries, each of these straddles. And also I've segregated from Monday, Tuesday, Wednesday, Thursday, and Friday. And then I'm getting, okay, this is the overall day-wise breakup and overall straddle-wise breakup, which is given 4.7 lakhs of overall profits. So what I've observed is, once I'm able to break out the number of overall trades versus overall returns, I could see that 94% of overall profits is coming from the first 4 trades. So the overall 4.7 lakhs, as you could see, only few thousand rupees is coming from the last portion, the fifth and sixth strategy. But 94% of the profits is coming from first 4 strategy. So which means that it doesn't really matter to trade the fifth and sixth entry. So initially, when I started creating the trading system, what I've mentioned is, you create this rolling straddle with 5 re-entries. I've mentioned here 5 re-entries. So that is just to keep, okay, we'll keep 5 re-entries. But once I dig deep, I'm able to see that as per the data, that the first 4 entries is more than enough. You don't really need the last 2 entries. So now my rules has been further tweaked to stating that, okay, I'm going to trade the straddle, but I'm going to trade only the first 4 straddle, not the next 2 entries. So after that, I wanted to dig deep further. Okay, straddle wise, the number of entry wise, I'm able to figure out the first 4 trades are good. So basically, you're re-executing only first 4 times. Now I wanted to see what is the average day-wise profits. So we are seeing overall 4.7 lakhs of overall profits, but I wanted to know what is the day-wise profits. Monday, what is the profits I'm making from first straddle? Tuesday, what is the profits I'm making from second straddle? Likewise, I wanted to segregate it. As you could see, on Mondays, overall profits is just 24 rupees, 25 rupees, 44 rupees, and 67 rupees, minus 22 rupees. So these are very, very minimal, which is not even sufficient enough to take the care of the transaction charges. So if I trade the strategies from Monday to Friday, then I might not make much returns. But when I focus on Thursday, on expiry days, I could see the average profit is relatively much higher than all other days. As you could see, on Mondays, Tuesdays, it is 20 rupees, 25 rupees, 30 rupees. But on Thursday, it is like 270 rupees, 350 rupees, again 214 rupees, 235 rupees. So the first 4 straddles on expiry days has given much higher average day profits versus other days. So this clearly tells me that, okay, if I continue to trade on other days, I just have to pay those money back to transaction charges. But instead of that, if I just focus only on Thursdays, only on expiry days, then this can take care of the transaction charges, as well as this can can give me very good returns, because I don't need to pay brokerage every single day. I just need to trade on only one day, which is on expiry day. So in a month, I'm getting 4 or 5 expiries in a month, so which is decent enough. If this strategy is giving me overall returns for 30% or 25% to 30% only trading on expiry days, then this is really good enough. So if I calculate what is the overall returns on expiry days, then this is the overall profits, where it has given almost 3 lakhs of overall profits, but the drawdown has gone down significantly, where the overall drawdown is just 5,500 rupees. And the winning accuracy has increased almost to 75%. And even the average profit per trade, even that also increased almost to 1,065 rupees. So when we compare this specific strategy, trading all days, trading expiry days, then it makes a lot of sense. Even though the overall returns is higher on all days, but when we dig deep and found out that average profit is very, very minimal on other days, and average profit is much higher on expiry days, it's good that we omit all other days and trade only on expiry days. So by trading only on expiry days, drastically we are bringing down the overall drawdowns and increasing the overall winning accuracy, and expectancy also increased. And the best thing is it takes the number of days in drawdown days. Like if you trade on all days, almost 118 days you have to be under drawdown. But when you're trading with only on expiry days, only 7 days you have to be under drawdown. So this has given a significant increase in overall returns. Like when we started the trading strategy, we wanted to create a trading strategy which can take care of the zigzag moves on all days. But eventually, once we dig deep, once we analyze the data on day wise, overall profits and everything, finally we concluded that, okay, this specific strategy is good to trade on expiry days. So this is exactly how we need to focus on creating trading strategies. So we did not have in mind that we wanted to create a trading strategy for expiry days, but the overall data analysis suggested that it is good to focus only on expiry days because the risk adjusted returns is good on expiry days versus all days. So if you calculate the overall returns on a year wise, so this is the overall returns year wise, like 2017, 18, 19, 20, 21, 22 for the last 6 years. If I calculate, considering 2 lakhs per lot, so you can add OTM options and reduce the overall margin requirement. But even without considering that, this has given me average returns of 25% with only 2% or 3% of overall drawdowns. So your overall drawdown is in single digit and your overall returns is in double digit, where 25% is more than enough to easily scale up your capital. No, you don't really need to make 80%, 90% returns. Even with 2 lakhs per lot, you can reduce the margin requirement to 1 lakh per lot also by adding OTM options. So if I add OTM options as a hedge, and then if I just make it as a 1 lakh per lot, then I can easily double my returns almost from 25% to 40% or 45%. And the overall drawdown will be from 2% to maybe 4% or 5%. That is also decent enough. So if you wanted to increase the overall returns, you can add OTM options as an hedge to increase the overall returns, or else you can be if you think that this is more than enough for you, you can easily trade without any hedge, where with 2 lakhs per lot you can trade it. And I always say, like if you have decent returns with the consistency, then you can easily scale up your capital. So as per this rule of 72, so rule of 72 is nothing but it tells you how much time it takes for you to double your investment. So if your investment is 2 lakhs, and if my overall returns is 30% and 72 divided by 30, it will give me 2.5, which means that my capital can be doubled every 2.5 years. So that is really, really good. If you calculate the same formula with respect to FD returns is approximately now 7%. So when you calculate 72 by 7, then it takes 10 years for you to double your FD capital. Whereas here you're able to double your capital in 2.5 years. So there is a huge deviation. So you don't really need to focus on making huge returns. Making small returns consistently is more than enough to double your capital. So that is what with respect to this strategy. So with respect to 24% returns on a average basis with a very minimal drawdowns, the first and foremost thing is you would be able to stick to the strategy because you're not seeing significant loss. So you will not have no problem in sticking to the strategy. You will not lose faith in the strategy. So eventually you'll stick to it. So once you're able to stick to it, eventually you'll become a disciplined trader. And once you become a disciplined trader, obviously, the profit follows automatically. So that is the main thing that you need to follow. And second thing is there will always be drawdown with respect to any kind of systems. So no matter what kind of trading strategies we use, drawdowns will always be there. But drawdowns are the main reason traders mainly quit. So because we always wanted to be right, we do not want taking a consecutive back-to-back losses, or we do not want it to be in a drawdown for a prolonged period of time. So that is why breakout traders or trend following traders suffers, because when you trade trend following or breakout trading, you rely on few large profits, and those few large profits doesn't come very often. So most of these breakout traders or trend following traders, their overall, like more than 80% of the profits comes from less than 20% of the trades. So we never know when those big trade comes. So as long as those big trade comes, we have to wait and we have to take all those small losses. So I'll give you a perfect example, of actual equity curve. So this is nothing but the actual live performance of a hedge fund called Dunn Fund. So Dunn is nothing but it is actually his name is Bill Dunn. So he's the hedge fund manager. So this is the performance of his fund from 1970 to 2022. So almost for 40 to 50 years of live performance track record he has. So the blue line that you see is the actual live performance of his fund. The red line that you see is actually the live performance of index, like the normal, just like how we have Nifty Sensex, they have S&P index. So compared to the S&P index, if $1,000 is invested in 1970, the S&P index would have given almost $2,15. I mean, almost 2 lakhs. Whereas if the same $1,000, if you have invested with respect to his fund, Dunn's fund, it has almost given 1.7 million returns. So that is so huge. And that kind of huge returns is possible only when you focus on all those small arrow marks. So minus 52, minus 28, minus 63. So all those arrow marks is nothing but the drawdowns. So even a guy like Bill Dunn, who is managing millions and millions of dollars, has to go through 13 drawdowns, which is greater than minus 25%. So if you have invested 1 lakh, then at one point of time, your 1 lakh can go down to 75,000. But eventually it recovers. But what you do when your overall capital wipes up from 1 lakh to 75,000, how you handle all those stress, how you are maintaining the discipline, that is all matters. So otherwise trading would have been very easy for everyone. So the rules, the strategies, and everyone, it is applicable, it is available to every single user. But when you go through all those pains of losses, how people are able to stick to it, and then eventually, when they are able to recover from that, that is how, that is what segregates the average trader from the successful trader. Even with respect to Bill Dunn, if you notice, 2008, almost 2007 or 2008, his overall fund value has gone down minus 63%. But eventually it recovered from. So it not only recovered the losses, it eventually recovered and then gone to new high, making new highs. So all such kind of systems, no matter whether you're following an option seller or option buyer, trend follower, mean reverser, any kind of system will go through drawdowns. So if you try to avoid all those losses, so only people who are ready to take losses will be able to make profits. If you're not even able to ready to take losses, definitely trading would be much tougher for you. So keep that in mind. So before we wind up, because whatever the trading strategies that you follow, there will always be drawdown. To try to stick to the drawdowns. Only the initial drawdowns will be tougher. The moment you sail through the initial drawdowns, then the rest of the drawdowns becomes much easier, because you think that as a process. You will slowly start moving away from focusing on profits to process. And once you follow the process, obviously, everything will fall in place. So people who wanted to execute this strategy, because in order to execute this strategy, you have to sit in front of a system, because you are not keeping the stop loss on the premium, you're keeping the stop loss on the underlying. So you need to focus on the market, and you have to set alert and see, okay, if the market moves 0.4% on the underlying, you have to come back and exit. So all these mechanical processes there. So in order to avoid that, we created an automated trading bot for all the users, where you can easily trade the strategy. So let me explain how you could trade this strategy through our trading bots, where it's totally free of cost. Let me explain by sharing my screen. Just give me a moment. Okay, I'll just share. Okay. So you go to squareofbots.com. So all you have to do is you can just go to squareofbots.com from your mobile or from your desktop. So once you go there, you will see this home screen. So you'll have multiple options to log into the brokers. You have brokers like LS Blue, Paytm, Angel, then multiple brokers. So you log in with Done. So once you log in with Done, it will take you to the Done credentials. So whatever is your Done credentials, just try to log in with your Done, and then it will automatically generate an OTP. So once the OTP is generated, you try to enter the OTP details so that it will take you to the dashboard. So let me enter the OTP. So now I've entered the OTP, and I'm now logging into the Square of dashboard. So this is kind of a small case, like just like how small case is for investing, where it has baskets of investing strategies, momentum strategies, multiple investing strategies. You just choose any specific basket and automatically the rebalancing happens, right? Similarly, we have baskets of trading strategies here. So, all these strategies, if you have, if you check on the top, if you click on high risk, it will show you what are the list of high risk strategies. If you click on low risk, it will tell you what are the list of low risk strategies. Similarly, if you want to do option buying, you can click on option buying. If you want option selling, you can click on option selling. So likewise, we have created multiple trading strategies focused specifically on options here. So once I know, say, suppose if I wanted to trade this, the rolling bot straddle, which is available only on Thursdays. So since it is Wednesday, it is not displayed here. But tomorrow when you log in, you would be able to see a rolling rolling bot straddle, which is RBSS. So just like that, you just have to click on that and give inputs. So if I wanted to trade 2 lots, and just click on 2 lots and click on trade. That's all. Now, all you have to do is once you give input, you can shut down your laptop or just close your mobile browser and move on to it. Because once it is given input, your input gets saved in the database and the bot will be in running state, just like how you're seeing here. Whenever this condition satisfies the rules which I've explained, if it is satisfied, the bot will automatically place the trades for you in your own done account. It will take care of the stop losses and everything. You don't need to do anything. So whatever the orders it created, those orders you would be able to see it here. And also you would be able to track the live PNL directly from your done dashboard, done app, or done website. Wherever you're using your done portal, you can easily track it. So not only the rolling straddle bots, you have multiple bots here. Like for an example, you have normal 920 short straddle strategies. We have machine learning bot, and we have auto adjustment short strangle bot, or we have directional bot. So multiple things we have. Even if you wanted to focus on any breakout systems, we have futures trading bot. So you just click on futures, or you can click on options buying. So this options buying bot, it triggers on an average only 6 or 7 trades in the entire month. It doesn't trigger every single day. Because as an option buyer, if you try to trade every single day, you'll lose more. But when you wait for the right breakout and then when you try to enter, there is the higher probability of making profits with respect to option buying. So even you can trade those option buying bot. You just enter the number of lots you wanted to trade, 2 lots, 5 lots, whatever the number of lots, and give 5. So only restriction is you have to log in every day from 9 o'clock, from 8 o'clock to 9 o'clock, between this window, and give input to the bot. So that because only after 8 o'clock all this automation takes place, all the APIs tokens get generated. So only then orders will go through. So you cannot give input at the night 9 o'clock or 10 o'clock and then the orders will go through. And also every single day we have to give input as per the compliance, because you can't give input and set and forget. So all you have to do is just come to squareofbots.com every day, log in with your done account, and whatever the bots that you wanted to trade, even with respect to the example which I've explained today, rolling straddle bot, which will be displayed tomorrow on expiry days. So you just click, give input, that's all. Once the input is done, automatically order will go through. By end of the day, by 3:20 or 3:15, the bot will automatically square off the orders for you. Even you don't need to do any manual interventions with respect to changing the stop loss or closing the positions. The bot itself will take care of the entry. The bot itself will take care of the closing the positions. So there is no manual, completely zero manual interventions required. And all you have to do is, I'll just share the link also. This is the link that you need to go through. So once you go there, and you can directly log in with your done and take a free trial. So the free trial will be available almost for 14 days. So for free trial. And also people who can directly go there and go to our home page. If you do not have a done account, you can open a done account under our referral link, which is there in the home page. So once you open a done account, then you would be able to access all the bots at free of cost. Like you don't need to pay any charges. Otherwise, we charge almost 15,000 rupees per year. But if you open an account under our referral by clicking this link here, then you would be able to access all the bots at free of cost. Otherwise, if you already have an existing done account, you can directly trade almost 14 days of free trial and access the bots. And once you access the bots, then you will understand how the overall logic works, how the stop loss gets placed. So everything you'll have an idea. So that is why it's better you initially trade with few lots first and try to understand how it works and everything, and then increase your overall capital and overall lot sizes and all those things. You can slowly increase or not. But before that, don't try to increase your overall lot size. And that is what I wanted to convey. So in case if you guys have any questions, please let me know. So I'll try to answer the questions in the next 10 minutes.
Awesome. Thanks, Kiru. Very interesting and insightful webinars. we do have some few questions actually, starting with the costing part of it. Kiru, can you please shed a light on that?
Yeah, it is 15,000 per year where you can access all the bots. So there is no restriction such as 15,000. If you pay, then you can access, the whatever the strategies, whatever the baskets of orders that I have mentioned, you can access it. And also you can trade with, more than one lot. But if you open an account, if you open a done account under our referral, then you don't need to pay that 15,000 charges. You can get to access all the bots at free of cost. And with respect to the concessional brokerage with Dun, so Dun charges 20 rupees per order, similar to Zerodha. But if you open a Dun account under your dependent, under your spouse name or your parent's name, then they charge only 10 rupees per order. So overall charges gets reduced to almost 50%. Can we log in after 9 o'clock? No, you can log in before the market opens. So from 8 o'clock to 9:15. So this is the overall input window. So between this time frame, you can log in anytime and give input. Did the RBS's returns include brokerage transaction cost? Yes, whatever the returns that I've mentioned there is after all the cost and after the slippages.
Awesome. We do have some questions on our YouTube channel actually, Kiru. So
Yeah.
start with firstly, can you there were some few users who joined a little later. This particular strategy is only meant for like Nifty and Bank Nifty, right? For
Yeah,
like
it is. Yeah, so I have tested with respect to Nifty and Bank Nifty, and it has worked in both with respect to Nifty and Bank Nifty. Both systems it works, but Bank Nifty has considerably given higher returns than Nifty, considering higher premiums. So it is recommended to trade on Bank Nifty. So and now I'm trying to create similar systems on Fin Nifty as well. So soon we will introduce the same bots for Fin Nifty also.
Okay, awesome. So there was already one more question actually, which revolved around the psychology part of it. So a user was asking like there are like four options. This is more of a trading psychology, how like which they would like your guidance on. There are four like days where the strategies are different kind of expiries are present now, right? So how do you think like a user a trader should actually make a mind of theirs, like which expiries they need to trade on, or like if they want to do multiple expiries, so how should their mindset be?
See, it totally depend upon the behavior of that specific index that they are trading in. With respect to Bank Nifty is kind of a beast. Like if you are trying to trade with Bank Nifty, you can easily see Bank Nifty dropping 100 points, 200 points very easily. But Bank Nifty, almost 2 years back, it was trading around 30,000 or 25,000 or that level. So the sudden drop of 100 points or 200 points was not very, very frequent, but now it is very frequent. So when you create a trading strategies, you need to understand the behavior of that specific market or specific instrument. And then accordingly, you would devise a strategy for that. So just because expiry is available for five different indices, if you deploy the same strategy on all different expiries, it might not work. So you have to fine tune it, or you have to change the specific strategy that suits. For example, Fin Nifty is relatively calmer than Bank Nifty.
Right.
So you can run any kind of non-directional systems easily on Fin Nifty compared to like Bank Nifty. It's more of you work well with respect to directional systems. So probably, the psychology or the respective approaches, understand the basic instrument first, study the behavior. You can just go to TradingView, go to Dun chart and see the historical expiry date charts. Even I've uploaded in Square of YouTube channel how Bank Nifty moved specifically on expiry days from 2017 to 2022. Almost 5 years of expiry chart I've uploaded there. So once you observe, okay, on expiry days, this is how Bank Nifty moves, and you will have an idea. Okay, most of the time Bank Nifty stays within a 1% range. So you'll have, so on expiry days, probably I should create a trading strategy. So that is why we have a trading strategy specifically on expiry days as well. So when you try to create a trading strategies, or when you try to trade all these different expiries, first understand the instrument and try to create trading strategies accordingly.
Awesome. A user actually asked, like a user he is an NRI, he trades from Europe. So the timing he would like to actually, is it possible for him to actually log in after 10 a.m. also? How does that? Or is it applicable for everyone?
Yeah, it is applicable for everybody. Unfortunately, because of the compliance part, everybody has to log in. Because if you share your user ID and password to a third-party platform like us, and if you save it, and tomorrow if our platform gets hacked or some security concerns happens, that is going to affect our users. So that is why we don't store any users' information. And we have multiple users from different time zones, from Norway, Netherlands, multiple different time zones. They usually set an alarm wake up and give input, and again they go back to sleep. So currently there is no options. Probably we'll try to work on this specific request on how handling different time zones people. But currently they have to log in as per the IST timing, 8 o'clock to 9 o'clock, and have to give input.
Awesome. So there is like one more user in our Zoom chat only, Dipesh. He's asking like, how is auto strangle bot is different from rolling straddle?
Yeah, that's a good question. See, auto strangle bot, it is kind of a strangle bot. So, but rolling straddle is kind of a straddle. So the auto strangle primarily focuses on options or strikes, which is a bit away from the spot. But rolling straddle focuses specifically on the spot, and the auto strangle doesn't wait for a specific movement to happen. Like for an example, rolling straddle, suddenly when there is a 0.4% movement, the underlying 0.4% movement happens, it changes the position. But auto adjustment short strangle bot doesn't focus specifically on 0.4% movement or any specific price movement. It analyzes all the options data, checks the IV, checks the premium and everything, and then only if there is any adjustments needed, it initiates a trade. So both are totally different altogether, totally different strategies. So does running short gamma strategies in low volatility make any sense? So low volatility is like, no, it's not like, okay, January to February, low volatility, February to March, again, high volatility. So currently, when there is no big uncertainty in the market will remain in low volatility zone for a long period of time. So for an example, 2017 was a prolonged period of almost more than 1.5 years. VIX was less than 12 or 15, no, 13. So for the complete year, if you tend to think, okay, it is low volatility, I wanted to avoid the strategy, then you will not be able to trade any systems at all. And because of the implementations of 0DT, 0 days to expire options, not only in Indian markets, even with respect to US markets, it is currently in low volatility regime. So low volatility regime is there to stay, but it is how we handle the sudden gamma move that happens on expiry days. As long as you're able to have a right control, right risk mechanism to handle such sudden gamma moves on expiry days, it's fine. Because if you try to avoid strategies on low volatility markets, you will not be able to trade at all. So it's better to trade on all kind of markets, but just make sure that you control the risks.
Awesome. There is a user actually, he asked Gautam, does this strategy use hedge? If no, then can we get edited for us? Like even like, can you please shed light on the level of customizations that we provide on?
Yeah, so with respect to the current version, whatever the strategies I explained as per the strategy in the webinar, the same strategies are applied. So currently there is no options to add hedge. We are working on it where you'll have a checkbox. Once you select the checkbox, hedge options will be automatically considered. So soon we are going to add it. Probably in a week or so, we'll add this option. So currently people manually buy the hedge. So before the order gets triggered at 9:20, they'll just log in at 9:15 and they'll buy a OTM options. Some 1,000 points away OTM options to get the hedge benefit or margin benefit. So soon we'll make this as an automated process with respect to the platform itself. So when they log in, once they select the checkbox, the hedge will automatically get fired.
Awesome. Kiru, actually, there's a very interesting question, and the user is asking the ones the strategies and everything which you put on Twitter. Is it like based on your own experience, or you use those strategies particularly? How about it?
Yeah, I trade only on expiry day. So whatever the strategies that I trade, first I trade in my own account, I deploy it, and then I'll see how it has performed. And then only I make sure it is available in the trading bot. So first I risk with my own capital and then see if it is working fine. And then only I move to the trading bot. So the same system which I've explained, the same system is running. So auto strangle, if you've seen, I would have posted on every Thursday, I would have posted the live results of how it has performed in the past. So almost for last 30-35 expiries, if you go and see in square of videos, it will be available. So every things which I'm sharing, it's actually traded in my own personal account. So those things I get shared, and those things is also available as a bot.
Awesome. And like Kiru, there's another question, like how many lots this like it can trade?
So the number of lots, maximum number of lots is based on the freeze quantity. So currently, I think it is 36 lots, I guess. So with respect to Bank Nifty, so at one point of time, one user could trade up to 36 lots.
Okay, awesome. Kiru, on a very personal question, which is actually again related to our little trading psychology part of it, that might be useful for traders. Basically a lot of decisions on the is based on FOMO basically for all the traders, like whatever is happening, what they hear on Twitter or like any of the channels and everything, there comes some biasness towards it because of the FOMO. So how should a trader control his mind regarding that and trade basically?
See, the fear of missing out will always be there, not only with respect to trading, with always any kind of career decisions. Even you have two career options, and if you wanted to choose one, because of this FOMO, you tend to make decisions. But with respect to trading, you focus on the process first. So these FOMO will come only when you focus on the outcome. Okay, what if in case if I miss this, I would have missed such a big trending move, big trading opportunities. All these regrets will always be there in trading. But that is why I said focusing more on the process will eventually take you to the profits. So just like how you're going to the gym, you are going to the gym because you wanted to lose weight or you wanted to be fit. There is certain outcome that you have in your mind, right? Okay, this is the result that I expect. You go to gym every day and you see that there is no overall improvement in 3 months. Obviously, there won't be any improvements in 3 months. But once you stick to it at least for a year, you would be able to see considerable output from the overall process. But if you focus only on the outcome, then within 3 months, you lose interest in going to the gym. But if you follow the process of going to the gym, okay, going for a chest workout, lat workout, bi workout. So when you overall focus, enjoy the overall process, then eventually the outcome will come and fall in your place. So the FOMO and everything with respect to trading psychology will always move out or totally will be out of the question once you focus on the process. Once you focus on the process, eventually the progress will happen.
Awesome. Thanks for actually giving the reference of gym and everything. Today being the International Yoga Day, it will surely help create the awareness. Kiru, once again, thanks a lot for conducting this webinar. I am pretty sure that a lot of users have got very required actionable knowledge, and this whole video will be live on our YouTube channel as well, so that if they want, they can visit it whenever they want. So thanks once again, Kiru, and also
Thanks,
just
Rahul.
a
Thank you so
disclaimer
much.
before we finish. Investments in securities are subject to market risk. So it's very important that you do your own research. You read a lot. You take proper actions before trading. So it's very important that we keep that in mind. Thanks once again, Kiru. We'll be back with more such insightful webinars in the coming days.